property to appreciate in value, of course, there's some economic influences, but even the property itself needs to stand out to get that recognition in value. And an asset manager's job is to ultimately try and find asset management opportunities to grow that asset. And that's what ultimately an asset manager or fundamentally should be focusing on. Yes, he also has oversight of the property, so he will manage or oversee the property management aspects of it. Is his asset fully tenanted? Is his asset painted? Is the lifts working? Has the air cons been maintained? Are there any issues from a health and safety perspective? Does it pass the health and safety issues? For example, plumbing issues, electrical issues. That all gets done by the property manager, but it's ultimately on the ownership or oversight of the asset manager. Further to that, he would also then look at what can I do to maximize revenue or maximize value of this asset. So we call it sweating the asset in the property term. And ultimately, that's somebody that, again, will try and find opportunities. Oh, listen, we've got a space. If we change the sort of configuration, as an example, we could potentially get more tenants in. That means more income. That means more value for the property. So that's an asset manager's function. So Billion Asset Manager was again another outsourced business that was providing services to Rebosis. So the transaction entailed three spheres. One, 3 properties that were being sold. There were 3 retail centers. The one being Forest Hill, which is in Centurion. There was one called Bay West. Sorry, 2 retail centers. The one being Bay West, which is a massive, I think, close to 90,000 square meter shopping center that was built in Port Elizabeth. And as well as Forest Hill being around 75,000 square meter shopping center was built here in Centurion. Those centers were being sold. Along with those centers, there was these 2 businesses. So Sphere 1, the sale of assets. Sphere 2, sale of Billion Property Services. Sphere 3, sale of Billion Asset Managers. Okay. The total transactional value, just so you understand it, was made up of close to 5 billion rand. The assets itself were around 2 billion or just over 2 billion rand each, close to 2.2 billion each. And then the asset manager and the property manager was the differential. So you looked at it, it's a 2.2, I'm just rounding up numbers here, and call it 600, takes you to a 5 billion rand value transaction. Why the complexity behind it? The biggest reason for it was because CISA was the CEO of Rebosis, as well as the owner of Billion of Billion Group. There's a massive conflict of interest. And with it being a listed property company, obviously governed by Companies Act, governed by the JSC, governed by the takeover regulation, et cetera, that became a big issue in terms of us having to try and take this transaction forward. The other big complexity around this was because of the scale of the value of the transaction, the Companies Act requires you to have 75% of your shareholders vote in favor of this transaction. So if 74.9% says, we are not interested, we want to do the deal, but you're short by 0.1%, the deal will not go through. Ultimately, shareholders need to give you that authority. And the difficulty was to try and get the shareholders across the line purely because they're going to be price sensitive. Okay, I want you to buy Forest Hill, I want you to buy Bay West for 2.2 billion. I don't want to pay 2.2 billion. Show me there's value behind 2.2 billion. And price became quite sensitive. Similarly, how have you valued Billion Property Services as a valuation? Or how have you valued Billion Asset Managers as a valuation? So that was a big point. And then secondly, look, your CEO is the CEO of the company, but he's also somebody that's going to make profit out of the deal. So I'm not entirely comfortable from a conflict of interest perspective. And the complexity sort of ran through as a result of those issues, which eventually led to a point where I had to take charge of the transaction in its entirety, and CISA had to sort of step aside just purely because it was deemed a related party transaction and not because of the conflict of interest.
So if I'm understanding you correctly, so CISA actually was removed from the negotiation. You then kind of took over the negotiation to try to put it across on the Rebosis side and on the Billion side, or how did you manage those two? Because you yourself were both kind of in both sides as well, weren't you?
No, I wasn't. So I was, because I was the CFO of Rebosis. Yes, I was, we had the asset manager, which we were all employed by, but it was an outsourced agreement. So I wasn't really conflicted in that regard. I was the CFO of Rebosis. So I took the lead in that regard. CISA would be part of negotiation, but whenever it became it'd be part of the presentation, but whenever we came to a point in time of discussing price, he would recuse himself. I would ask him to recuse himself, just so that we could make it a completely unbiased environment. And then, shareholders are talking to somebody that's not conflicted in any what way. And that complexity sort of resulted in the transaction, unfortunately, getting a lot of negative press initially. So there's a lot of, there was a lot of coverage from a media perspective on this particular transaction because of the scale, etc. The initial sort of thought process behind this was negative, and this is honestly, you guys, I'm sure that you'll be able to pick up some stuff on the forefront of the transaction. And what then became an issue was, look, and behind the scenes, there's a whole bunch of stuff that still needs to take place. I was just leading the process as the ultimate, call it project lead of this, but there was still the compliance aspect. There was still the financial aspect. There was still the JSE aspect. There's a number of myriad of different requirements that needed to be fulfilled in the background. Drafting of agreements, ensuring that you've legally been compliant in a number of things, getting contracts drawn up with the respective people and the likes. So the transaction was very complex as a result of that. But because the mindset was so negative from the onset, the biggest hurdle was trying to change the mindset of people and helping them understand there is value in what we're trying to do here. And the value will be for you as a shareholder, ultimately, should the transaction be successful. And that was sort of, that was the hardest part of the journey, taking somebody that says, absolutely no, I'm not prepared to do the deal. And, if I recall correctly, initial sort of view was we would have, I think, 25 to 27% of shareholders being voting in favor. We needed 75. So that was seriously short in terms of where we were going to land. I can proudly say, the process was as tough as it was, but when the voting took place, we got 88% of shareholders to be voting in support. So a massive transformation from day one being, and that was it was over a period of, call it 10 months or so. Day one, call it first 3-4 months. Yeah, it was just listen, we're not even interested. But the process thereafter, in terms of consistent engagement, consistent financial analysis, consistent value creation projections and the likes, showing shareholders this is the value that will be uplifted by doing the transaction, was ultimately what got us to where we are at the moment, or at that point in time. The key factor though was, and I have to emphasize this, is that it's one thing buying properties, because that was the largest part of the transactions. One thing buying properties. It's a whole other thing thereafter. And as I said earlier, managing them. It's what you can buy a property. It could be valued at a very high point in time, but if you don't do the necessary work in terms of keeping that value uplift, the property value can be destructive as well. And that's a key point that needs to be noted.
Okay, great. Thank you very much. And I think for my small property journey, the management has always been the most difficult part and the most irritating part. So I can definitely understand your point there. So moving the needle. So maybe if I could ask a bit more detail on. I mean, I've worked in a business where started a business, two of us. Now, even trying to get two people to agree is hard, right? And now you have a listed company, multiple shareholders, multiple interests for whatever reason. How did you manage to convince them, over 80% of them, to vote with you for the deal?
Simply so, Shika. I've based my life or my career really based on facts. There's one thing trying to sell a dream. You can try and sell. Good salesmen are people that can sell ice to an Eskimo in winter. The reality of the matter is, today the world has advanced to a point where no one's going to buy the ice. That's just the simple point. If it's cold, I don't need ice. What I'm trying to get at is that you can be a good salesman. You could be somebody that's gifted with a good tongue in terms of trying to convince people. But the reality of the matter is, everybody ultimately wants to see value. They want to see value in terms of what can a transaction bring to them. And these are smart individuals who we're dealing with. So the best way I thought of approaching this was really showing facts. It was literally taking hard financial facts, because at the end of the day, it all comes down to the numbers, and saying, okay, if you're paying X amount, if you're paying this amount for this asset, if the management team of the company execute on just managing the asset in a basic manner, this is the value uplift. If we do A, B, and C, this is the further value uplift, and ultimately depicting what value creation was going to be made or yielded rather out of the transaction. And that was the key part of it. The second element of it as well was listening to shareholders. Because it's one thing saying, I want you to pay X amount for the asset, but if you don't, if a shareholder doesn't want to pay that amount, I'm sure there's some level of justification behind it. And negotiation skills are critical. Now I know you've titled this discussion under commercial negotiation, but that's what it was. Pure hard commercial negotiation. Both parties will always have a point. Both parties will always believe that they are right. But at some point as you enter into a discussion, always be willing to listen to the other party. And what I found was that, look, there was some aspects of the negotiations that were being placed by the shareholders that were justified. I couldn't remove myself from saying, listen, you guys are talking rubbish or talking nonsense. And it was about listening to them, and it's about also understanding their prerogative or their point of view. And on some of the properties or some of the pricing, yes, we had to find a common ground to make the transaction work. Because if a shareholder believes, let's do simple numbers. I wanted you to pay 100. Shareholder believes, no, I'm only going to pay 90. But he has very strong justification as to why it's 90. You tend to then want to work towards a midpoint, or something that would be commercially acceptable. Because those reasonings are very real. And probably you may not have thought about it, or you have thought about it, but listen, you were being cheeky about it. So negotiation was a fundamental part in terms of the commercial aspects of the transaction, being the price point, particularly. And I think, those two things, showing hard facts, showing where value creation is going to be, and essentially, and I implore this to everybody on this call, or guys, if you're going to do anything, be it small scale or big scale, of course, this example is of the biggest it's going to get. But anything you do, make sure you spend the time and effort in understanding the transaction. So one, make sure you understand the asset. Oh, when I say asset, I mean property. Make sure you understand the property. Make sure you understand the aspects of the property that are positive, the pros and the cons, the strengths and the weaknesses. Understand, very importantly, what are the projections from a forecast perspective. What I mean by that is, how is the property going to perform in the next couple of years? Simply put, if you understand those aspects, you then will be able to draft or determine a plan to address value uplift for that property. I know what my weaknesses are. This is what I got to do to fix it. I know where my strengths are. This is what I could do addition to those strengths to make the value go up. I know what the status of the properties. This is what I need to do to manage it at the very least in terms of getting just economic value uplift. If I do these things in addition to it, I get additional value uplift. So again, why I share this with you? On a broader scale, that's what I did in terms of this transaction. I brought hard facts to the table, and then you sort of present those facts. And similarly, when when you're talking to anybody, also be open to understanding things that you may have missed, and be willing to enter into a negotiation to potentially find a common place, especially if you're dealing with third parties, if you're dealing with a bank, or if you're dealing with your own investors. Always be amenable to listening to their point of view, and also, if their point of view makes the right sense, certainly amenable towards some form of negotiation that would make both parties, comfortable. And that, Shiko, got us from 25% to 88%.
Wow. So a lot of work over 10 months, but a lot of back and forth. But you got the deal over the line and created a huge amount of value, I think, for the investors at the time, on both sides of the deal. So I think, and for me, that's probably one of the key things around commercial negotiation in particular, is how to make sure that both parties, when they leave the deal, both sides are happy. And would you feel like that was the case in this case study in particular?
Absolutely. Now, I think at the end of the day, the uniqueness around this transaction, again, because it's governed by the JSC and the likes, is shareholders formally in black and white vote in favor or against the transaction. And if I really hope and pray that nobody voted in favor but was still unhappy. You know, I think
Yeah.
the lovely thing about the listed environment is that there's, you know, shareholders have full rights. You know, they have their full rights of say, and the only and their biggest form or ability rather to communicate and to ultimately express their opinion and view is through the voting process. So, you know, the fact that they voted in favor meant that they certainly were, you know, were comfortable where the transaction landed at that point in time. Yeah.
All right, great. Thank you very much. So with that, we're now going to go to the question and answer segment of today's call. We already have Lindo, who's asked a few questions on the chat. But before we go to Lindo, when people were signing up, we also asked them a few questions if they wanted to ask a question in the meantime. So there's one question in particular, which I thought is an interesting and good place to start. And that question is, how do you start buying and selling property when you have zero capital and unfavorable loan terms? So this is going not away from the listed environment where billions are being made. So I thought this is a good place to start because it's a lot of people who are at the beginning of the property journey. How do you start from there?
Sure, that's tough. I have to be honest with you. Look, I think realistically, and I guess anybody would appreciate this. If you have zero capital on your own capacity, or if it's through sort of external resources as such, the biggest problem that comes into play in property generally is the banks are not going to be willing to finance you. But let me caveat that. So, you know, I always believe that if you're going to look at buying property, you should always look at utilizing or maximizing your lending capability from a bank, because the reality of the matter is that's what they're there for. Of course, you pay for it, you know, then nothing's for free, but the reality of the matter is it gives you access to capital. So, you know, what I have seen over the recent years is that, look, some banks have moved their sort of lending profile or lending criteria to much higher lending ability. So what I mean by that is, if, you know, again, if you need 100, you know, some banks I've seen are willing to lend you 100. But again, the very key thing on that is it all then is determinant on one, your credit score or your credit profile with the bank. So that means is that, are you a highly credit rated individual with the bank? You know, have you had a record with the bank? You know, have you ever defaulted with the bank? Obviously, if you have, you're not going to have a good credit score. You know, have you been with the bank for a long period of time? Have you had consistency in terms of a job or income that has come into your portfolio? But by and large, look, that, you know, to try and get 100% facility is really hard. And now, so with the economic environment having unfortunately you know, depreciated significantly more because of the impact of COVID, you know, I think banks are very, very cautious to lend towards 100% of what your facility is. So realistically, and to answer your question, I think it's going to be very, very tough to try and buy a property without some element of cash. The other key aspect of it is, if you are looking at a property and you, again, need to look at funding, the closer you will get to the 100% mark is, and also very much determinant, not only just on your credit score, but the quality of the property. So if you're buying, you know, and again, if you're buying something small, big, let's use the example of a residential townhouse as an example, you know, do you have a tenant in that townhouse? You know, is there a lease in place for 3 years that can guarantee that income? Have you taken a deposit? Have you done credit checks against that tenant? You know, is a tenant credit worthy? Will the tenant default in any what way? How much income are you getting in terms of that lease? You know, will that income cover you? Are there any other expenses against that income, such as levies or electricity, or are those being carried out by the tenant? You know, what is your final cash flow position on a monthly basis, and will that then cover the interest that the bank's going to charge you? So again, you know, to be quite blunt with you, and I guess to get to the point on this, is that it's tough to buy property without any capital. If you are going to try, it's going to be very difficult unless you've got a really good credit background, and the banks are going to put their trust in you. And very importantly, the property will have adequate income to service the debt. Service the debt meaning pay the monthly interest or installment that needs to take place.
All right, great. So thank you very much for that. So just a follow-on from that. So one of the questions that we had emailed into us was, how do you get funding for projects? So in the scenario that you just painted, I think one of the main areas that you have suggested is the banks. But I think many people's experience is that the banks aren't lending, right? So are there other avenues other than looking at the bank to get funding for your project that you want to start?
Yeah, look, I think simply put, and again, I'll come back to what I said just now, is that for me personally, and maybe it's, whether I've done things in my personal capacity, whether I've done things for corporates on the large scale that I've shared with you guys earlier, I've always looked at debt funding because there's an amazing benefit if you buy a property and the return on that property exceeds the rate that you're paying from an interest perspective. It's called the benefit of gearing. Now, I don't want to get too financial, but that concept, if you understand it, and again, I'll have to, we could do that a separate session, unfortunately, but the benefit of gearing is tremendous in property. So I always encourage you need to get some level of lending or gearing from the bank. The issue though is, again, and you rightly pointed out, Jiko, that it's an environment that's constricted. COVID has caused the banks to become very conservative in terms of lending. So your only alternative outside of, again, I would strongly encourage them to look at some form of financing from the banks, probably look at a low amount. So instead of saying, I want to get 80% of the banks, maybe look at 50%. But then you're going to have to find that other 50%. And there are there are individuals, there are a lot of investment companies that are willing to look at, investing into smaller transactions. A lot of people in their personal capacities are willing to look at putting their surplus cash towards an investment. They call them angel investors as well. But I have to very strongly caveat that, anybody that's willing to invest, again, in today's times, because of the environment that we operate in, a lot of times, and I know we do it as well, I'm not going to give somebody money as a donation. You'd want to sort of get a level of return on that investment. So yes, if somebody says, I want to lend money from you and I'll pay you an interest value back, that's all well and good, but the reality of the matter is I also want to see the value uplift on it. So you must be willing to accommodate some of your ownership of that property to that individual, if that individual is willing to sort of invest into you.
Okay, great. So thank you very much. And I think that one lends itself as well to a lot of the work that we're doing at the Mampeule Foundation, because I think with the profile of the South African Housing and Infrastructure Fund, with Raleigh Mampeule's profile as well, a lot of people will even approach me, even though I don't have all the money, I'm just in the foundation, and just asking, to get support on that. And I think oftentimes it's not really about that it's not a good idea, that there isn't value. It's just that the timing might not be right for money to be given. And oftentimes it's better to, if I'm understanding you correctly, you need to also have a track record that people will then be able to say that actually, you know what, Rico has actually invested in 10 different properties. He's getting this amount of revenue. You can prove it, prove how well he's working over the last 3 years. Therefore, let's invest in him. Rather than if I just appear and I have a great idea, it's harder to invest in me if in that case, right?
Absolutely, and exactly what you just pointed out is the same criteria the bank's going to look at as well. So it sort of applies in both ends of the sort of financial, I guess, lending aspect of it, be it a bank or be it an individual.
Okay, great. So thank you very much. So we're going to move to the next question. So it's around how to now enter into either large property projects or commercial property. What's the step that someone who's interested in the space, what can they do to enter that space?
Enter in the space in what sense? Enter as an investor or enter as a participant of the development as such?
Yeah, so participant, if I'm Rico, I have 2 residential flats that I have right now, but now I'm like, you know what, I want to do a little bit more in the commercial space. What would be the natural next step for me to take in that case?
I think, look, again, and again, it's unfortunate. The property is expensive. Bricks and mortar, unfortunately, comes with a cost. The reality is that you do need capital. So if you let's use your example. If you've got 2 flats, you want to now look at what your next steps are. It depends on how those two flats are doing. Are they performing well enough? Are they giving you good enough income flow? Are they servicing the debt that you've got against them, or servicing whatever financing you've taken out against them? And essentially, my advice would be in that particular instance is to try and grow your portfolio. Again, if you've got a tried and tested track record, it just makes you more marketable towards entering into the bigger type of transactions. The reality of the matter is, and we've done some, we do some, and we have done some really large scale transactions, large scale value transactions, and similarly to the question you've raised, we come in as a potential new partner to the transaction, to the development, but we have to bring money. That's the unfortunate thing. So in the instance of trying to get bigger, I would recommend focusing on your own portfolio in the instance of your question, and seeing how your two assets are performing. Again, the banks are very much sort of encouraged by a good track record. So if those two assets, you bought them over a few years and they're growing in value, the tenants are paying, there's no issues, it's been well run and managed, those assets become value on your balance sheet, right? So your value is now grown. You bought them for 100. In 5 years' time, now they're worth 130. You've now made 30, even if it's on in terms of value on a piece of paper. The banks are going to finance you against 130, not against the 100. Do you understand what I'm saying to you? So it gives you a window of opportunity on that 30 differential to now utilize that as potential collateral for future acquisitions as such. And that's the way I'd recommend it. But the lovely thing about property is, if you manage property correctly, property should generally always grow over a period of time. Property is not something you manage over, you value it over every month. It's something you value over a period of time. Yes, we go through ups and downs in terms of our cycles, but the reality on average, you generally find property always moves upwards, if it's in the right environment. Again, I shouldn't say always, because if you buy a piece of property that's 50 kilometers away from the metropolis, that's no one ever wants to live in, it's never going to grow in value. But if you buy something that has the right location, a good tenant profile, it's an attractive asset in terms of its sort of the style of it. It's well maintained. Generally you should see an uplift in property value as such.
All right, great. Thank you very much for that. So the next question I have, just as in terms of still on the commercial property side, and it's speaks to the question around transformation in commercial property in particular. To what extent, I mean, we can only see the buildings that we see, right? So you walk into Braamfontein, Central Joburg, Sandton, and all of these things. And you see buildings that are going up, you see commercial properties that are out there. What, from your experience, what's the level of Black participation in the property space right now in South Africa?
To be honest with you, too little. Absolutely, without a doubt, too little. And perhaps we spoke about a guy like Cisa early on, or perhaps a guy like Raleigh. The reality of the matter is that there are too few of them. There are few, but they're not that many in comparison to what they should be. So I think the sector is coming extremely short in that regard. Look, there are some aspects of development that do take place by some prominent Black individuals, and that's great. But on a law of averages, certainly not enough. One encouraging thing, and maybe this is more because it's easier to govern, and it's focused now more on the listed space. It has been the property charter that was released, I think, 2 years ago, or the revised property chart and the new codes. And again, why I say listed space, because it's more enforceable in the listed space, but it just obviously does apply to general property companies as well. And the move has been to try and get between 25 to now 30% Black involvement and ownership in new ventures. So again, the issue though is it's not like the mining code, where the mining code has now become almost regulation and legislation. This is sort of, I'm hoping, would go in that direction, where eventually it becomes a hard and fast rule that you got to do it. But I just don't think that there's adequate sort of involvement of Black companies, or the right transformation involvement that there should be. What we do find as well is you sort of get invited, if you are a prominent BE player, you do get invited to participate in a project or a development, as I highlighted earlier. But again, you've got to come with an equity check. Gone are the days where someone's going to say, yeah, I'm going to give you 25%. Just for bringing your B score to the table. No, it's you are a B player, great, but we also want you to participate and bring that money as well.
Okay, all right. Understanding that then, so how is it? Is it an education thing? So how do people break into? So if I'm not a well-known person in the property space, like I'm not now, but I want to break into it, what are the opportunities? Is it around education? Is it around, I just have to wait my turn over the next 5-10 years, build up my portfolio, and then I can get invited to the table? Like what can I do to start being considered and to participate in that in that part?
Look, I think I do think that I think opportunities are endless. I really do. I think that you need to evaluate your own personal portfolio and your own personal value in context of what you've already done. And then ultimately try and target the next step. So, if you've owned 2 properties, don't expect to be part of a 2 billion rand development. It's not going to happen. Unfortunately, that's just how life is. Unless you have a skill set within the property sphere as a Black entrepreneur that is required in that development. Of course, that is, B procurement in context of BEE parties is a priority. It's something that ranks very highly in terms of your BE scoring. So, that is obviously something that's different. But as an investor, I think the focus should be in terms of firstly evaluating your own portfolio, evaluating the performance of your portfolio, evaluating the true value of your portfolio, i.e., what would a bank value it at? Okay, see what the differential is, and then try and continue growing that portfolio. Yes, the second thing I'd also encourage is if you do know of other companies or individuals that are in sort of similar space in terms of size that also have sort of done the same thing in terms of property, look at potentially consolidating, look at potentially entering into a agreement between both parties through like a joint venture, or just one company buys out the other, but it's 50-50 shareholding and the likes. Because again, scale is important. I spoke about we did 6 billion to 24 billion. When you say you 24 billion, scale is phenomenal. People have more trust in somebody that's bigger than smaller. So that's also another opportunity. A consolidation of smaller companies is also worth exploring as well, or trying for you to try and enter into amongst other sort of small entrepreneurs.
All right, great. Thank you very much. So with that, we're going to move into the current situation with COVID and what that means currently for the property space. And so we have a question that was sent in by email, and this is the last question from email. It says, with most people working from home and companies realizing that you don't need a permanent space, what does the future of commercial property mean?
So there's been a lot of discussion around this particular point, and this is a great question. A lot of discussion, a lot of articles, a lot of media coverage on this particular point. Let me share with you my view, and I've had a few debates about this particularly recently. But I think that this way, well, I mean, the fact that we're having this call and doing this sort of session in this manner, yes, we're forced to do it because COVID, is ultimately created this environment for us. Call it the new normal, or if you want. But I want to emphasize something very important. There was always a very strong focus, and maybe not so much so in South Africa, but we saw a lot of this in the more developed markets, and I'm talking property-wise, for people to start alternative forms of working. So remote style of working, i.e., what we're doing now, and connectivity has shifted fundamentally from 3 years ago to where it is today. And secondly, or alternatively, temporary sort of working solutions like the WeWork environment or the Regis environment in South Africa. And why so? Because you only come in as and when you need to come in. So if I needed to have a meeting with you, Shiko, and we couldn't do it over a phone call, we had to look at each other, we could do it this way, and it still didn't work because we needed to sign some agreements, then we would set up a virtual office as such. It was explored quite heavily overseas, and funny enough, you see, pre-COVID, you saw some of the big giants such as the Amazons, such as the Facebooks, the Googles, that whilst they had phenomenal they call them campuses where they worked, they also had a lot of remote stuff. And you can check this, you can Google this and research this. So it was people were moving towards this mindset where, listen, I'm more productive if I'm at home. I've got a family, I work 8 to 5, but if I've got to make sure that I'm ready at my computer at 5 to 8, I've got more time with my kids instead of having to sit in the car. Do you understand? And commuting to work every day. Or what does the commute do to you in terms of your productivity? You spend 2 hours in the car coming and 2 hours in the car going, or 2 hours in the train, as it is internationally. What does it do to your productivity? So this was something that was explored quite heavily. COVID just forced us into it. So my view is that, I think realistically it's worked. I don't see any company has folded because they now have to use Zoom or Teams. And I don't think any company has gone under purely because they weren't able to do face-to-face meetings. It's effectively shown us that this really can work. And I do believe that the one class of asset that's going to struggle is commercial property. So I think that, a company, let's use a Discovery as an example. Discovery would need all their call center staff to come in. I think they'll need some of the executives to come in, but again, come in as and when you need to come in. But do they really need that big building anymore? I don't know. Personally, I don't know. Because, I know a lot of the big blue chip companies have said, no one needs to come until March next year. And I was speaking to somebody at Old Mutual yesterday, for example, and they said, I think March next year. So, realistically, it's working. So these new developments from a commercial perspective, and I say commercial, I say office, I think that's particularly going to take a bit of have an impact on. Secondly, I think retail, so I think shopping centers, online shopping has been successful. South Africa's had a serious uplift in online shopping, but I still think the South African mindset is to, listen, let's go to the mall. It's easier versus, only doing online shopping. So I don't think it's going to be impacted as much, but I think there will be some level of an impact. But other classes, I spoke about speciality. Student accommodation, you can't, everyone still has to go back to campus. No one's going to do remote learning. So student accommodation will still remain and still be a priority. Industrial assets, whether you buy online or whether you go into, mall, someone needs to store your goods, right? The warehousing needs to take place. So industrial properties will still remain. And actually, in fact, I think it will grow. And similarly, storage. I think storage will be another area that will continue to be on the up. So I think the big one is office, and I think retail. And I'm very confident that I think, the new way of working is this way, but it's going to be a hybrid structure where you come in as and when you need to, but you don't need to come in all the time. And I think it's been successful thus far, and this is the way we're going to be going towards working in the future.
Okay, so thanks a lot for your insight today. I think I actually had to go for a medical checkup at the Discovery building, and it's kind of spooky to walk into this huge, beautiful building, and literally there's like 6 people, so that space, the office spaces, I think are going to change significantly, but I think hopefully it's an opportunity as well. I think we asked earlier on around what's the Black participation. Do you think that there's an opportunity there in terms of like, can we start to make deals in that space to enter it because like no one is actually there right now? So there's an opportunity. Is there?
Yeah, certainly. So look, I mean, it's a buyer's market when it comes to office. There's no question about it. It's a buyer's market just generally in property. Unfortunately, COVID had so pre-COVID there was a massive impact on property. I mentioned that when we were doing our listing as well, and just has never recovered. But COVID has really wiped out market value, and I'm talking purely from a property listed perspective. As a result, it's become a buyer's market. So yes, there's opportunity for Black entrants to get into property. I have to caution anybody that I would speak to, get into property, guys, but office wouldn't be my first choice. Let's use the Discovery example again. Discovery probably, if they had to rent out that building, I don't know what they pay, but let's hypothetically say it's R1 million a month. I mean, I don't know for a fact at all, but if it was R1 million a month, and I'm pretty sure it's much higher than that. Let's say they take 50% of that space and they can save 500,000 Rand a month. That's 6 million Rand a year. It's a lot of money. Do you understand what I'm saying to you? So that's the way a lot of the CEOs are thinking at the moment. That's the way the CEOs were thinking, like the global CEOs were thinking pre-COVID. Do you understand? And again, South Africa is unfortunate in terms of, no one knew we were going to grow this quickly, but from a commute perspective, the productivity levels get impacted. Frustrations in being in your car, being late, being on time, etc. Whereas saying I could work from home 75% of the time and only need to be in the office perhaps from 12 till 2 on a Thursday, means I don't have to worry about traffic. I can be there on time. It's a short amount of time. I have more time with my family. I'm happy as a person, and I'm much more productive because I can spend the full 8 hours or 9 hours a day at my computer versus having to be in a car. So, and again, most importantly, the CEO is going to say, listen, I've got money I can save. Ultimately, the company's going to make more money by not having to rent or pay for office space.
All right, cool. So thank you very much. So we're now going to move on to the questions from the chat. As I said, the first question was from Lindo, and it's still related to kind of the pandemic. And so it's around student accommodation. What does the future look like for the student accommodation space and broader real estate as well? So student accommodation, especially because of the pandemic, you seem to be very bullish around that.
Yeah. Firstly, Lindo, I do know Lindo, so good that you joined, Lindo. Thank you for making the time. My view is, look, I have to be honest with you. COVID has had an impact so COVID over the last 6 months has had an impact on everything. There's nothing except for industrial assets that would not have been impacted, because the reality of the matter is, even student accommodation, no one was allowed to go to school, go to university, right? So you didn't really need that student accommodation. You were at home with your folks during the lockdown period. But look, with the ease of the lockdown and the likes, and the sort of new normal that we're entering into, universities are open up and the likes, people have to go back to university. It's going to happen again next year. All schools are open, all tertiary institutions are open, which means that people will have to have accommodation closer to the universities, those that do that, those that don't commute. So student accommodation for me still remains a priority. And Lindo, I think the stat that I had raised earlier around, there were 300,000 beds short for what, 4 years ago. That's probably now 500,000 or not more. You can't, the demand versus supply is so disparate, it's scary. The reality is that it's going to take a very long time for the two of them to meet. So realistically, it's always going to be a priority. But for me, key thing, price point. Don't build a 5-star hotel that you're going to charge 10,000 rand a bed. No one's going to pay that. And not many people can afford to pay that. Very important if you are looking at getting into student accommodation. NSFAS, there's a big fund, of course, the National Student Funding Association, if I'm mistaken. And they have a fixed price point that they pay for per bed every year. You should very much try and coordinate to align yourself towards what those numbers are. Because that means that you're going to have a large opportunity of students that are going to be ultimately funded through this NSFAS program that you could ultimately rent out into your establishment as such.
All right, great. So thank you very much for that. So student accommodation, great opportunity seems to be there, but also just to be careful around how to manage that. So the next question we have, and I think it's going to be the last question, as we are running out of time, is from Kopano, and it says, what are some of the key aspects to consider when negotiating public-private partnerships with the state? So if I'm starting out, I'm a small-scale developer, and I want to work with the state. What should I be careful of? And is that an opportunity that we should look at?
Yeah, look, I'm a big supporter of PPPs. I think realistically, government has money. I mean, they've got allocated amount of funds for development purposes. So, if you do have an opportunity to enter into a PPP with government, certainly do so. I think, but at the end of the day, look, be it government or be it anyone that you're going to enter into a transaction with, make sure you do your due diligence. Make sure you ensure that there's validity and there's support and there's dedicated commitment from your partner, be it government or be it whoever you're going to enter into a transaction with. Make sure that if you're going to enter into the PPP, the right paperwork is in order, you've got the right legals in place, and importantly, you've got the right, when I say commitment, legally committed sort of deliveries and activities that need to be delivered against a specific timeline. That's important because you then mutually agreeing on doing something together, but then mutually agreeing on putting in the right amount of effort to meet those timelines. by signing on that. And the other big part of it, especially if you're going to look at it from a government perspective, is ensuring that the dispensation of, so if there's going to be a fund, the funding element of it from a government perspective, sometimes there's always bottlenecks, or more often than not, there's bottlenecks, when you're dealing with government, because it's such obviously a massive sort of organization as such. Make sure that you've got level of comfort on that, because sometimes you could be doing a lot of work, but not necessarily getting the sort of the funding being provided timelessly as such. I've seen a lot of that happen on these mega city developments as well, where people put up big, a lot of number of homes in affordable housing, but then, the disbursement of funding sometimes takes its time. So those are some of the risks, inherent risks that I think are not just associated with government, but generally. But yeah, get the necessary support in black and white. And I always encourage having it formalized through a firm timeline, so I expect X amount to be received on this date. I expect this activity to be completed on this date. Have a formally committed timetable, and I guess a project plan that is committed to in black and white and signed against by both parties. So then at least you've got some sort of legal ground, or some level of recourse to stand against if you're putting the time and effort and it's not being reciprocated.
All right, great. So with that, thank you so much for that very comprehensive answer, Kameel. And I just want to thank you once again. You are our first guest on this property masterclass for the Rally Mampeule learnership. And I think it's been a wealth of knowledge that you've shared with us. A case study of worth over 24 billion Rand in and of itself, that you were able to negotiate over 10 months. I think it's amazing to be able to speak to someone. To be honest, I've never spoken to someone who's done a deal that big. And I think for many of us, we to have that opportunity, I think we really, really thank you. Thank you so much, Kameel, for all of your time. And yeah, so thank you very much, Kameel.
Well, thank you again for inviting me. I hope I could have shared some knowledge with everyone that joined the call, and thanks for everyone for joining. I think my parting message to all of you is, guys, Shiko sort of mentioned to me that he gave me some background in terms of the individuals that are part of sort of this program, and I wish you all the best, guys. I wish you absolutely all the best. There's a massive amount of opportunity for each and every one of us, and the reality of the matter is we are masters of our own destiny. We got to take every opportunity and make the absolute most of it. So I wish you the best. I really do, and make something out of your life. Property is a great place to be in. It's a very, 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 very successful place to be in. But at the same time, you got to make it a success, and I encourage you to do so. So good luck and all the best.
Thank you very much, Kameel. And to everyone who's joined us today, we really appreciate your time. I know it's in the middle of your days, but I think it's been something that you've learned a lot from. We look forward to having more guests. We're going to be having this call once a month, and we hope you guys can join us again. If you have learned any particular tidbits that you would like to share, please make sure to tag the Mampeule Foundation, and under the hashtag Rally Mampeule Learnership, please make sure to tag us on Instagram, Facebook, and on LinkedIn as well. So thank you very much, everyone. Have a good rest of your day, and we'll see you next time.